And on Thursday, the 8th, bonds began the overnight session several basis points higher in Asia right from the very first trade. The entirety of the remaining session was spent orbiting those same levels in a choppy but narrow range. Sellers showed up at the start of the domestic session. MBS were down 25 basis points early, with jobless claims coming in pretty much on forecast. It's not likely there's a big reaction as yesterday. Jobless claims came in at 230,000 on a 230,000 estimate, up a little bit from the 226,000 previously. Continuing claims came in at 1.67 million on a 1.6 million forecast. It was 1.609 previously. In other news, used cars declined 0.3% in November, month over month, and are down 14% year over year, which is a big number. Cars were really expensive last year, and they're back at the prices that prevailed over a year ago. Cars enjoyed the smallest year-over-year decline at 10.5%, followed by vans and sports cars at 11.6%. Pickups were down 11.9%. Mid-size cars fell more than the average at 14.4%, as did luxury cars that tumbled 15.6%. Luxury cars were very expensive, but we're going into a recession. Yet another contraindicator sign on what the hell is going on with this recession. At the end of the day, we were down 31 basis points, ending up at 101.02. The 10-year was up 8 basis points on the 30-year. That put us right in this small end of this very narrow range, which is bordered by a ceiling at 101.688, which has kind of popped up as a new technical indicator. But the floor is still that 100-day moving average at 100.966, which is kind of turning into a bit of a pivot point, but it's holding up pretty strong as a floor. Producer price index comes tomorrow. Experts are thinking there's a reasonable chance it makes a big move lower. This will be followed by the CPI next week and the Fed meeting, so probably won't be enough to move them off of the 0.5 hike. However, it could impact the statement and subsequent meetings. We also got a post from our sponsor at WellThatMakesSense.com. Once again, this is from that book, Persuasion, by Robert Cialdini, who is brilliant. There are dread risks in persuasion. Dread risks, which involve risky steps that people take to avoid harm from something that is actually less risky, but they happen to be focused on at the time, thereby coming to events. For example, they used September 11th, where after September 11th, everybody was very scared to fly, though there actually wasn't any extra risk. It was just that thought was in our heads. And Friday the 9th was the day we've been waiting all week to get that PPI data. Bonds were slightly stronger headed into the PPI data, but since moved into weaker territory in the morning. MBS were mixed depending on the coupon early this morning. Inflation at a wholesale level picked up in November, according to the BLS. The producer price index was up 0.3% and 0.7% year over year. Again, the year over year is supposed to be around 2 to 3. Driven primarily by final demand of servicers and basically wages. The PPI excluding food and energy, which is the most important one that the Fed looks at, was up 0.3% month over month and up 6.2% year over year. This report was one of the last pieces of data before the Fed meets next week. We get the CPI on Tuesday. So a lot of people are going to trade based off of what they think this means for the CPI that will come right ahead of the Fed meeting. Part of December, according to the University of Michigan Consumer Sentiment Index, all three components improved on a month-over-month basis, and they're still lower than a year ago. It probably reflects the falling gasoline prices. These consumer confidence things highly correlate with gas prices. Inflationary expectations eased again, which is good news for the Fed. Inflation expectations hit a 15-month low. They are still higher than a couple of years ago. Expectations are an interesting thing because there's still an element of our population that believes in Santa Claus, so it's good to believe in things. Doesn't make it true. Home equity increased 15.8% year over year in the third quarter, according to CoreLogic. At the end of the day, we ended up down 14 basis points at 100.88. So 100.88, which puts us right below that 100-day moving average and going down towards that very, very strong floor of 100.534. So the CPI and a bunch of the data next week will drive a lot of that. Here in 2008, at the start of the housing bust, household spending on goods was 34% of income. It quickly fell to 32% in early 2009, near the end of the recession. It was then, in just a couple of months, it skyrocketed to 40%, a bump of 4 percentage points that previously took 11 years to happen. It's still at 40%, 2.5% above pre-COVID trend. So people are still spending a lot of money, which is causing this inflation and racking up a ton of debt. Federal Reserve data has the total mortgage debt for 1 to 4 family residences at the end of June at $13 trillion, a record high. Back in 1970, it stood at 292 billion, or 2.1 trillion if you adjust it for inflation. Part of the increase to that 13 trillion is over the past half century is through the loss of dollars purchasing power versus real estate, and part of it is due to the growth in the size of the housing market. Also, financing homes has become a whole lot easier. The amount of mortgage debt outstanding has recovered from the drop that took place in 2008 to 2014, when the total declined average of 1.8% per year. Those years have been the only ones since 1970 to see mortgage debt decrease. Looking at the economic calendar for next week, it is a big week. We've got a 3-year and a 10-year note auction on Monday, which could move things. Then we get the CPI number on Tuesday, which technically isn't supposed to impact the Fed decision, but it's hard for them to ignore it. Wednesday, we get the Fed decision, and then on Thursday, we get the Bank of England and the ECB statement, as well as a Philly Fed Business Index. So it's going to be a wild one next week. So rest up, and if you feel like learning some stuff, check out our common sources and influences, which include our sponsor at WellThatMakesSense.com. Have a great weekend, everybody.